price increases. Some folks have raised worries that this could be a sign of persistent inflation, but that's not our view. Our experts believe, and the data shows, that most of the price increases we've seen were expected and are expected to be temporary. The reality is you can't flip the global economic light back on and not expect this to happen. As demand returns, there's going to be global supply chain challenges. We've seen that in semiconductors, which are used in automobiles. That global shortage has slowed vehicle production, creating a temporary spike in car prices. That's a real challenge. My administration will do everything we can to address it. But again, these disruptions are temporary.
364 days later.
Inflation hitting its highest level in, get this, 41 years. June's consumer price index shows inflation rose more than 9% from last year, and that's higher than economists expected. Since May, prices jumped 1.3%. It's the biggest monthly jump since 2005.
But here we go. I see jobless claims at 256,000. That's up 5,000 for, oh my gosh. Boy, not only was I wrong, down 0.9% on first look at second quarter GDP, down 0.9%.
That doesn't sound like a recession to me. Thank you very much.
Disperse! Nothing to see here, please!
All right. Today is Tuesday, August 2nd. This is a recap for the stock market activities today. And folks, I got a good one for you tonight. We start with this, the obvious news. We're going to talk about the wall of worry, by the way. And in the wall of worry is China. Of course, today you might have heard the news that the Speaker of the House, Nancy Pelosi, arrived in Taiwan, despite multiple warnings from the Chinese government. Pelosi punched, and now we're waiting for the counterpunch. What we know for now is the Chinese government announced military exercises really close to Taiwan, and that will take place starting tomorrow. But what concerns us here is the economic response, because there is an economic punishment that will come from China. In other words, brace for impact. What are they going to do in response? They know that Nancy Pelosi is obsessed with the stock market. They know that U.S. companies are highly dependent on the Chinese economy, so they can inflict huge pain for the stock market and for the U.S. economy. We're now waiting for the response. But the question is, was this really necessary? Why was Pelosi there to begin with? Perhaps to find the next big trade, because the Nvidia trade, that did not work out. They got outed out in the media. Everybody was talking about it. So the Pelosi's had to dump before the CHIP Act was about to be passed, and they dumped at a loss, even though the stock was actually higher before it took a turn down. But because they have call options, those call options went down in value. So what is Nancy thinking right now? Shorting Taiwan semi? Shorting something? Buying calls and something else? I don't know. Maybe buying calls in the defense contractors? Those stocks were higher today. Something is going on here. We're about to find out. But this was not without warning. Before the visit, there was a phone call between China's Xi and President Biden, and Biden was warned by the Chinese president not to do this. Of course, Biden told Pelosi not to do this. She did it anyways. Something is going on here. Brace for impact. We're going to see the response. But what was behind all of this deal of the visit? Which stock is about to pop? Because that's what it's all about. But when we talk about the wall of worry and all of these geopolitical tensions and the impact on the economy and the stock market, it's not just China and Russia. We have another wild card in North Korea, because Comrade Kim is now threatening to use nukes amid tensions with the U.S. and South Korea. Here we go. Another one. Let's have a party over there, a nuclear party. Now, in other news that took place over the weekend, and perhaps this is connected to what we're about to talk about in this video, President Biden apparently still has the thing. We were told that he recovered, it's over, it's done. Now we're told that he has a rebound, quote-unquote, case. Wow, a rebound case? How about we call it the Dennis Rodman effect? You see, this administration, they're masters in propaganda. everything they do is propaganda. When the thing that was supposed to cure the other thing did not work out, they told you it's a breakthrough case. Like an actor, Marlon Brando had his breakthrough role back in 1969. And it goes for the economy too. It's not inflation. It's transitory price hikes. It's not a recession. That's the new one. It's not a recession. It's a transition. You know, the economy used to be Bruce. Now it's Caitlin. That's all there is. It's not a recession. You're just imagining things. The insane bill that they're about to pass right now, some say $400 billion, others say $700 billion. When you spend that much, when the country has the highest inflation in 40 years, that sounds delusional. Yet they call it the Inflation Reduction Act.
We choose truth over facts.
And of course, we're all wondering why Senator Manchin caved. What was the reason behind that? Some people say promises, sweetheart deals by the Democrats of pipelines in West Virginia. Who knows? Or maybe just he needs a new Maserati because he's into Italian cars. He certainly got something because otherwise it would have been a shellacking in the midterms. Or perhaps Senator Manchin came to his senses and he realized that there was more money in the EV green mania. There was no money in oil and gas. That's over now. All the oligarchs, the billionaires, they're shifting to the green/EV, whatever. And the car manufacturers certainly tried to get Manchin on their side. Look, Senator, lots of money here in these EV batteries and stuff. Come on. You can buy all the Maseratis you want. By the way, the shittiest car that you can buy. Seriously, if you make money, don't buy a Maserati. Everybody will know you're a fool. Anyhow, folks, we got a good discussion here ahead of us, so let's do that, and here it is. In focus tonight. Propaganda. When all else fails, resort to propaganda. Here we are, back to the wall of worry. Things are lining up again. Things are getting hotter all over the place. We have concerns, we know that. Russia, Ukraine, we know that. Now, when it comes to the thing, it is dormant for now, but it might heat up this fall/winter season. We'll see. The Fed, that remains a concern, big one. Today you heard more hawkish talk from Mr., from Williams, from Evans. All of a sudden they're becoming hawks. And therefore you saw the dollar and the 10-year yield shooting up higher and the stock market took a leg down right away. But we also have DC and China lining up again. The tensions with Taiwan, but we also have a lot of chaos in DC. And in this episode, we will talk about the chaos and the circus going on at what we call the brothel in DC. Take a look.
And let me speak to one other issue. The GDP and whether or not we are in a recession. Both Chairman Powell and many of the significant banking personnel and economists say we're not in a recession. But let me just give you what the facts are in terms of the state of the economy. Number one, we have a record job market of record unemployment of 3.6% today. We've created 9 million new jobs so far, just since he became president.
Okay, he's lying through his dentures or whatever. There was no job creation, Mr. President. All what you've done is recovered the jobs that were lost due to the thing crash. This is the chart from the Bureau of Labor Statistics. There is no net positive job creation in the economy. Not at all. Matter of fact, we have yet to recover the payrolls that we had before the crash of the thing. Back in 2020, the Great Panic. So when he talks about job creation, who do you think you're fooling? The majority of job losses happened in the travel and leisure sectors due to the lockdowns. And now that we don't have the lockdowns anymore, we're seeing a revival of the travel and leisure sector, at least in hiring. That's all there is. When you talk about job creation, the reality says the labor force participation is down across the board. Among all ethnicities, the labor force participation has yet to recover, and it might not recover for a long, long time. More lies from Joey B.
Businesses are investing in America at record rates. Foreign business like SK and others are investing in America. Hundreds of millions and trillions of dollars, sum total.
Here we go, another lie. Business investment like never before, really? The GDP report, which came out showing an annual decline of 0.9% in the second quarter of this year, this is the back-to-back decline. It is the first one since the 2007-2009 Great Recession. In the report, look at the second paragraph here. It reads, business fixed investment fell at 3.9% rate, the most since the early stages of the pandemic. Spending on equipment, a good sign of future growth prospects, fell at 2.7% pace. Builders also slashed investment in new housing. So what are you talking about here, Mr. President? We're seeing companies laying off employees. We're seeing companies delaying investment plans. Yet the facts don't matter, right? We choose truth over facts. Get your facts straight, Jack.
$100 billion in semiconductor investments already announced by Intel, Samsung, and Texas Instruments. More than $100 billion in electric vehicle battery investments by Ford, General Motors, Hyundai, Tesla, and more.
Another lie, they're not investing billions of dollars. They're getting subsidies, courtesy of the taxpayer, of course. Now, the taxpayer doesn't have a choice or a voice at the brothel in D.C. They all work and represent the oligarchs, but we keep voting for them for some reason. But we passed billions and billions of dollars of subsidies to GM, Ford, Tesla, all of them, to build EVs and batteries. We passed over $200 billion in the so-called CHIP Act, another subsidy, another handout to the chip industry. They're not really investing. It's a quid pro quo. You give me money from the taxpayers, I invest that in the economy, and we call that a win-win. Who do you think you're fooling here? Continuing.
And just last week, as I said, SK Corporation of the Republic of Korea announced $22 billion in new investment in semiconductor batteries, chargers, and medical devices, creating another 16,000 jobs here in America. And this is powering the strongest rebound in American manufacturing in over 3 decades, creating 613,000 manufacturing jobs.
Here's another lie by Joey B. He says this is the biggest rebound in manufacturing in this country, creating over 600,000 jobs. The manufacturing industry is coming back. Bullshit. We got the data this week from the ISM, and U.S. factories grew at the slowest pace in 2 years. That's the booming the kabooming economy, Mr. President. The Chicago Fed Manufacturing PMI has completely collapsed to the lowest level in almost 2 years. So I guess the manufacturing industry is doing pretty good in the economy, right? The Philly Fed Manufacturing Index is collapsing and now reading into contraction territory. The data, the numbers don't lie, Mr. President. And when we look at other districts, from Philly to Kansas City, Dallas to Richmond, all of them are showing either 1.5 to 2 years low readings, indicating that the manufacturing industry in the economy is indeed collapsing. The manufacturing PMI is at the weakest reading since July 2020. Business activities are diving down big time, according to the Composite of Purchasing Manager Index. It is at the second lowest reading since 2020. More lies.
Passing the CHIPS bill is going to put another $72 billion for incentives and tax credits to expand semiconductor production. And the Inflation Reduction Act will add another $370 billion in clean energy tax credits in reconciliation, including incentives to accelerate domestic production of solar panels, wind turbines, batteries, and critical materials processing. That doesn't sound like a recession to me. Thank you very much.
And by the way, if you're saying there is no recession, this is not a recession, then why the panic? Why on Friday everybody and their mothers in the administration came out assuring us in the media that this is not a recession, calm down, nothing to see here, please disperse, the economy is doing great, you're just imagining things. The GDP data is lying, it's Russian propaganda. And I say if that is the case, why the panic, Mr. President? Why send all of these people in the media spewing propaganda all weekend long? Take a look.
I do want to emphasize what a recession really means is a broad-based contraction in the economy. And even if that number is negative, we are not in a recession now.
And certainly in terms of the technical definition, it's not a recession. The technical definition considers a much broader spectrum of data points.
The idea that 2 quarters of negative GDP growth is a technical definition of a recession is wrong.
If things are going so great, though, then why is it the White House officials are trying to redefine recession?
No, we're not redefining recession.
If we all understand a recession to be 2 consecutive quarters of negative GDP growth in a row, and then you have White House officials come up here to say, no, that's not what a recession is. It's something else. How is that not redefining recession?
Because that's not the definition.
And it didn't stop here. On Friday, and this is really Orwellian when you think about it, President Joey B got in the fake set of the White House that they have for him, with the little kid chairs the notes, the teleprompters, and he brought in CEOs across the country from banks, from hotels, to assure us that the economy is doing just fine. The economy is actually booming. And I say, why the panic, Mr. President? Why get all of these CEOs right after the GDP reading to assure us that the economy is doing just fine? And by the way, all of these CEOs, specifically the bankster from Bank of America, did nothing but spewing lies. Lie after lie after lie. Take a look.
What are you seeing right now in terms of financial health of your consumers? What's the bank records tell you about the financial health?
Well, thank you, Mr. President. It's good to see you recovering. So at Bank of America, you have 60 million consumers and 35 million core checking accounts for Americans. And so the couple key points. Number one, they're spending more money. Through the first 25 days of July 2022, they've spent 10% more than they spent in July of 2021, the first 25 days. And that's consistent with what we saw in the whole second quarter and earlier this year.
So he says the consumer is doing great. You guys are doing great. What are you complaining about? Consumer spending is through the roof, or the roof, as some people would say. The reality is consumer spending is only going higher because of inflation. You think we're really that stupid? Maybe we are. I don't know. But consumer spending is moving higher because inflation is costing people more. They're spending more at the pump, at the grocery store, utility bills, not because they're buying more, not because they have more income. They're spending more because the prices are going higher by the day. But rest assured, nothing to see here. Everything is great. The consumer is doing fine. You guys are doing fine, right? More lies from the bankster.
The second key point, I'd say, Mr. President, is their balances are much higher than they were in the pandemic. And so if you look at people of sort of $100,000 income families in our client base, you'll see that their balances go from 3 to 5 to 7 times more than they were in the pandemic. And by the way, they have grown in the month of July versus June so far, which is good news. So they have some money in their accounts still to help them through as the economy resets and settles in.
Here's another lie, saying that households have savings and disposable income, their balances are looking good. That could not be any further than the truth. We will look at the personal savings rate as a percentage of disposable income in the United States. Yes, it shot up higher in 2020 and 2021 due to the lockdowns and the stimmies. But now inflation ate all of that away. Everything is gone now. Matter of fact, the personal savings rate in America just hit its lowest level since the Great Recession, even as rates on saving accounts have risen. You know why? Because they have to spend more. They have to exhaust their savings when we have record high inflation. But I know the inflation is transitory, the recession is imaginary. It's not imaginary here. Nearly a quarter of American households have no emergency savings at all. 23%. No emergency savings at all. Think about it. 1 out of 4 people that you see have no emergency savings at all. But according to the propaganda from Bank of America, the CEO, you guys are just doing fine. Your savings are good, your balance sheets through the roof. What recession? Meanwhile, inflation is so bad, even high-income Americans are now going to the dollar store. But hey, according to the administration, maybe they're just looking for deals. That's not a sign that the economy is doing bad. Everybody loves a bargain once in a while. Come on, man.
Come on, man.
The third thing is on their borrowing. Our credit statistics are better than they ever been, much better than 19, which was a pretty good credit year for banks. So delinquencies are low. They haven't gone up in the month of July. There's lots of credit availability for our customers, and their ability to borrow in the home equity lines or their credit cards.
Another lie. He says that his credit statistics are pretty good. You know why it's good? Because consumers, households, have no other choice but to swipe those credit cards up and down, up and down, up and down to cope with this inflation. That's good for the banks. They make more money. Then he says that the credit situation is pretty good. There are no delinquencies, yada, yada, yada. Really? Today we got the stunning data. The credit card balances jumped 13%, the highest leap in over 20 years as inflation outpaces wage growth. The consumer cannot cope with this inflation anymore. So the last resort is using those credit cards. What do you do when inflation is at 9% and wage growth is at 5%? Net, the average worker is down about 4%. There is no way you can make up for that without using credit cards. When you have the prices of bread through the roof, you go for a small trip to the grocery store and it costs you an arm and a leg. You wonder why the consumer is going insane using credit cards. And by the way, they talk about the great consumer. The great consumer cannot even pay their phone bills, according to AT&T. And again, today, the New York Fed gave us data that Americans' credit card debt just had the biggest jump in more than 20 years. You think this will come with no consequences? Interest rates are moving higher. We're about to see a tsunami of layoffs in the economy. What happens when all of these people max their credit cards and then they lose their jobs? Bankruptcy all over the country? Bailouts, an economic disaster, a depression. And folks, when they talk about no delinquencies, the credit scores are great, there is no risk like we saw back in 2006, 2007. That's not going to happen again. Well, American households' debt hit record $16.2 trillion as mortgages, credit card spending swell, but also delinquencies creep up. We're seeing more mortgage delinquencies. We're seeing more car repos. Folks cannot pay their cars anymore. And soon enough, when they lose their job, they're not going to be able to pay their credit cards anymore. What happens then? How much pain do they have to endure? When the bankster talks about the great consumer and households having savings and access to credit cards, the reality is 61% of Americans are living paycheck to paycheck. And the most shocking finding is even those earning $200,000 or more a year, 36% of those say that they're living paycheck to paycheck. You know why? Because $200,000 in Palo Alto, where the tech companies and these kind of salaries are, that's nothing. That's poverty wage. Between the property taxes, the mortgages, the income taxes, you got nothing left. When it comes to those making minimum wage, they're now earning less than 60 years ago, before most people were even alive. Is this the booming economy, or is this an economy about to head off a cliff into a massive, massive recession? More lies, this time around not from the bankster, but from Marriott CEO. Take a look.
What's your sense?
Well, thank you, Mr. President, for the invitation today. I think what we've learned over the last couple of quarters is really the resilience of travel. And when we look at our forward booking data, we see real evidence of that resilience. And what's interesting, we think about our business through three demand segments: leisure, business travel, and group. The recovery has clearly been led by leisure. And in fact, last year, leisure demand got back to where we were pre-pandemic. But what's encouraging is we're seeing real recovery in the other two segments. Business transient's been a slower recovery, but as we see more and more folks returning to the office, we see continued improvement. And maybe the biggest surprise has been the pace at which group demand has come back. And correct. And we fully expected social group to recover quickly with all of the canceled weddings and bar mitzvahs and family reunions. But now we're seeing strong and consistent recovery in business group travel as well. So quite encouraging.
So I guess Marriott is now a bar mitzvah company. When he says the consumer is doing great and traveling is surging, no problems here at Marriott. We're doing fine. The economy is booming. Oh, really? The revenue per available room for Marriott, when we pin these numbers to 2019, if you say that the economy is booming and is doing great, then we cannot compare it to 2020, 2021. We have to compare it to 2019. Well, the revenue per available room in international hotels of Marriott were down by almost 23%, in the US and Canada down by 6.1%, and worldwide down almost 11%. The occupancy rate versus 2019 for the international segment of Marriott down almost 16%. When it comes to the US and Canada, down 8%. All in all, worldwide down about 10.4%. So is this an economy that is booming when the occupancy rate is way below 2019? But how is Marriott making up for all of that? The answer is, how about price gouging? Charging those who are traveling, able to travel, can afford to travel, the affluent consumer, charging them more. But I guess this is the kind of price gouging that the administration is okay with. Price gouging is bad when the oil and gas industries do it. Even when they don't do it, the gas station owners, the mom and pops, they're guilty of price gouging, not these companies. But the propaganda tour did not stop here. We also got Janet Yellen, who should retire, by the way. She was all over TV on Friday, over the weekend, saying that this is not a recession, the economy is doing just fine. Take a look.
Most economists and most Americans have a similar definition of recession: substantial job losses and mass layoffs, businesses shutting down, private sector activities slowing considerably, family budgets under immense strain, in sum, a broad-based weakening of our economy. That is not what we're seeing right now. When you look at the economy, job creation is continuing. Household finances remain strong. Consumers are spending and businesses are growing. As one example, in the last 3 months, our economy has created over 1.1 million jobs. In the 3 months beginning each each modern recession outside of the pandemic, our economy lost 240,000 jobs on average. Spending by businesses and consumers, the core of our economic activity, rose by 3% in the first quarter of this year and continued to expand in the second. Industrial output, the measure of our manufacturing, mining, and utilities sectors, has shown strong average growth over the first half of the year compared to sharp average declines during past recessions.
And I say that the only reason I should see this penguin again on TV is when she's announcing her resignation. I'm hereby today to announce my resignation effective immediately, and that you're never gonna see me again. That's the only thing I want to hear from Janet Yellen at this point. Transitory Yellen. Now we're gonna trust her in a recession? Of course not. Now look, folks. We can play this game and say it's not a recession because this or that, or maybe the definition of a recession is outdated. You can play that game, but the fact and the realities don't lie. We have a back-to-back decline in GDP, not as severe as we've seen in 2020, not as severe as we've seen back in 2009, granted, but again, the data doesn't lie. Look at the U.S. yield curve, for example, the most reliable, the most accurate indicator of a recession. Every time the yield curve has inverted, it has always been an indicator for an upcoming recession. We now have the most severe inversion in the yield curve that we've seen in at least 2 decades. That suggests that this upcoming recession will be even more severe than 2020 and the Great Recession of 2009. Yet these propagandists are saying nothing to see here, everything is fine, calm down, put your blindfolds back on. Even the corrupt so-called economists, 1/3 of those, are now saying that there is a U.S. recession ahead. And what really matters is how we feel as consumers. The number of mentions of a recession, the R word, in news articles have absolutely exploded, the highest level since 2020. You can run, but you can't hide. You can do propaganda, and the sheepies will fall for it, but the facts don't change. Leading economic indicators are all collapsing and pointing to a recession late this year. Consumer sentiment absolutely collapsing. And yesterday we got construction spending data. That's also collapsing. Is this a booming economy, or is this an economy that's about to head into a recession? Small business optimism. The index is at all-time lows. We have never seen small businesses this pessimistic about the economy, even during the Great Recession of 2009 and the Great Inflation of the 1970s. Company after company are coming out warning that their profits are plunging, their margins are going down, inflation is killing them, and they're now finding out that they overhired and overordered goods. So they have to eat a loss, number one. Number two, they have to get rid of employees. Walmart was the latest, issuing a massive warning, and on top of that, the flash PMI reading also pointing to a massive deterioration of the U.S. economy. The data doesn't lie. The only thing going on good for the no recession crowd, for the propagandists and the administration, their allies, is the fact that we're not seeing severe job losses in the economy yet. Keyword yet. The payrolls are doing good, and the argument is, how could you say that we're seeing a recession right now? We have one of the lowest unemployment rates in history. People are getting paid, they have jobs. How could you say that we have a recession? My rebuttal is, have you ever heard of a lagging indicator? You ever heard of the fact that employment is the last block to fall? We're seeing the warning signals, and the tsunami of layoffs is coming. What would the administration say when that happens? Still not a recession? The warning signs are here. Ford announced last week laying off 8,000 employees, a massive number. And more to come. Once again, they can lie all they want. They can produce whatever kind of propaganda they want. Brian Deese can come over TV every single day telling us that this is not a recession. The data doesn't lie. What the data is pointing out to, a recession is coming. Buckle up your seatbelts. I mean, it's one thing when you have an administration that is actually prepared, that is actually frank with the American people, saying, look, we have a recession coming. Here's what we're going to do to reduce the impact. But you have an administration right now that is entirely in denial. They're going to get caught by surprise, just like they got caught with the inflation surprise. They said it was going to be transitory. Turns out it's not transitory. Now they say there is no recession coming. And when they say that, you know for sure, 100%, a recession is coming. With that, let's move on to cover the stock market information. Let's start with the closing of the indices today. And here we go. The Dow Industrial Average was down by 402.23 points, or a decline of 1.23%. The Nasdaq down by 20.22 points, or a decline of 0.16%. The S&P 500 also down by 27.44 points, or a decline of 0.67%. Here are the sectors' performances today. At number 1, capturing the gold, the silver, and the bronze, technology. The rest all in the red, led by financials, real estate, and materials. Although I have a hunch that we will see technology moving down in the next few days. On one hand, we have the dollar and the 10-year yield moving higher. The Fed is sounding more aggressive. And on top of that, we have the response. We're waiting for the response from China. And there is no doubt in my mind that China will inflict economic pain. Stock market hitting technology companies, who knows? But I think technology will move down, and maybe utilities will creep up back higher again. What about the advance to decline ratios? NYSE 35% advancing versus 61% declining. The Nasdaq 52% advancing versus 42% declining. Commodities, this is not how energy commodities closed for the day. This is how they're trading at the time that I'm recording this video. They were all flattish for the most part, even though crude futures, the WTI, Brent, even the gasoline RBOB were trading a lot higher earlier in the day, but by the end of the session, they gave up the majority of the gains. The loser for the day was natural gas, down big, now trading at around 7.5 per BTU. It was about 9.5 just a week or so ago. So we're seeing a lot of volatility here in natural gas, and we'll see more of that. Now, the options bettors are betting that we will see a gap. The gap will continue between the WTI and Brent, which will command a premium over the Texas WTI. When it comes to natural gas, even Bank of America is now coming out and saying that the European natural gas crisis is going from bad to ugly. It's about to get a lot uglier as we head closer to the winter season. And the question is, where will the Germans get their supplies from? They need to tap their reserves all the way to the top to get off Russian natural gas entirely in the upcoming season. But if they cannot do that, they have to cut down on their consumption. We see rationing. We see austerity measures. You think this will be good for the German economy, European economy? Of course not. And if the European economy goes down, we will have ripple impacts all the way here. We will not be spared. When it comes to softs, we're seeing declines, continuous declines for lumber, given about 2.5% today. Likewise, coffee down about 2%. Cocoa down modestly, losing about 0.5 percentage point. And then we have muted action for cotton and sugar futures, while the winter OJ futures scoring gains of about 1%. Metals down across the board big time. The dollar rebounded big time, about 1% today for the dollar. Gold down, silver down, platinum down, copper down, palladium down. Nobody was spared here. When it comes to meats, muted across the board, some modest losses led by feeder cattle futures, which lost about 1 percentage point today. Now, when it comes to grains, we're seeing more losses for soybeans, soybean oil, corn, wheat, oats, canola, with the outliers scoring some gains being soybean meal and rough rice. Keep your eyes on grains. When are we going to see the translation at the grocery store? When are we going to pay less for food? Is it ever going to happen? Because they say inflation is peaking. Grains futures are down, meaning the Fed will have to be easier and more gentle in their approach of raising interest rates. And that means you should buy stocks. The worst is behind us. But will inflation really go down, or is it going to stick? Because guess what's going on here? Tampa ammonia, when we talk about fertilizers, those prices are moving higher again because natural gas prices over in Europe moving higher. And that's going to push the cost of producing fertilizers. That is an input cost for farmers. Are they going to eat a loss because they cannot sell their crop at a profit? They're paying more for fertilizer. They're going to have to charge more. And the assumption is if natural gas, that's the key. The key is natural gas. If natural gas continues to move higher, it will move grains futures also higher again. Keep your eyes on natural gas, the most important commodity right now. Moving on to the big casino, the options market, what's going on here? Last week, we saw an improvement in the volume all in all. Lots of call options buying. This week, things are kind of fading away. Yet the put-to-call ratio still maintaining an improvement from, let's say, a month or so ago. But we need to see more of that. If you want to see a continuation of the rally, we need to see more buying of call options. What I'm seeing right now is a rotation from last week from buying calls to buying puts again. And the volume is moving down. With that being said, here it is at number 1, Tesla. At around 1.3 million contracts traded today, about 60% of those were calls. Tesla is seeing a short squeeze / gamma squeeze, so everybody's stampeding to buy call options here. My hunch is it's going to fire back, especially if we have bad news from China. If China is going to retaliate using Tesla, we'll see. Apple at number 2 with around 1 million contracts, about 44.4% of those were calls. So they're buying more puts here. And I did buy puts on Apple today. I'm going to discuss in the charts analysis. But here it is at number 3, AMD at around 900,000 contracts traded today. About 63% of those were calls. AMD is down after hours, not by a lot, but 4 to 5%. The key to tomorrow's action, in my opinion, watch if they're going to buy the dip in AMD or not. If they do, higher we go in the stock market all in all. But if that dip is not bought, that's going to be a problem and maybe the beginning of at least a pullback. What about the unusual activities that took place in the options market today? We start with the ticker UNG. This is for the natural gas ETF, or fund I should say. It was down big today, but somebody's bidding for a rebound. They bought the 28 calls for the expiration date August 12th with expectations that the name is going to rebound and score gains of more than 6% by then. They paid about $1 a piece to enter this trade, all in all spending around $1.5 million. I did follow this trade, by the way. I believe we're going to have a rebound in UNG. We'll see. Next, we have the ticker LCID, Lucid Motors. Somebody's fading the rip here, buying puts, specifically the 16 puts for the expiration date, October 21st, with expectations that the name will go down by more than 19% by then. They paid around $1.5 a piece to enter this trade, all in all, spending around $1.7 million. And then we have the ticker RVNC. This is for a company called Revance Therapeutics, whatever that is. In the biotech sector, the name surged higher today, scoring gains of about 7%, and somebody's bidding for more gains to come. They bought the $20 calls for the expiration date, October 21st, with expectations that the name will move higher and score gains of about 19% or more by then. They paid around $2.5 a piece to enter this trade, all in all spending around $2.5 million. And lastly, the ticker ZM for Zoom, which is one of the top performers in the last few days, single-handedly lifting RKK because RKK got slaughtered with Roku and Teladoc, but Zoom is moving higher. Somebody's fading the rip in Zoom. I mean, what rip, right? The stock is down big from the top, but it is ripping higher from, let's say, a few days ago. Somebody's fading the rip here by buying the $90 puts, expiration date August 26, with expectations that Zoom will move down and lose more than 17% by then. They paid around $2.75 a piece to enter this trade, all in all spending around $3 million. Moving on to the heat map analysis, what's going on here? Weakness across the board with few pockets of exceptions. Some of these are driven by earnings. Some of these are driven by short covering. For example, when we talk about short covering, look at names such as Snapchat, DoorDash, Twilio, Match.com, all moved higher on the heels of Pinterest moving higher after earnings. But I think Match is down about 20% after hours, so that's fading away right away. And then you can see Zoom. Zoom is ripping higher. Perhaps it is a time for a pullback. Another outperformer was the software sector, not all of them. Not the old school ones, certainly. We also saw Chinese names moving higher. Alibaba, JD, Pinduoduo, Tesla, all moving higher. We also got short covering in the travel names, cruises in particular. And then we have biotech moving higher. Certain names also reported earnings and had certain catalysts to move higher. And that pushed the XBI to be the winner for the day, at least from the ETF's perspective. We also got LMT, Lockheed Martin, and industrials. The defense contractors moved higher. The Pelosi trip, the tensions with China, all of that is good news for the defense contractors. Maybe Pelosi is buying calls on LMT, who knows? But besides that, weakness across the board, financials down big, even though rates are moving higher. Have you noticed that we have an inverse relationship right now between financials and the 10-year yield? When the 10-year yield went down, financials moved higher. Now when the 10-year yield is rebounding, we see financials down. What does that say? It says that financials, contrary to the common belief that they should move higher when interest rates move higher, what banks are saying, if interest rates move higher, it means that the Fed will increase interest rates higher. Good for business, right? Wrong, because higher interest rates by the Fed will cause a recession, and that's not a good outcome for banks, no matter how you slice it. We also have certain losers in consumer defensives. For example, in beverages, alcohol, down across the board, led by TAP, Molson Coors, and perhaps the stock of Molson Coors got the kiss of death by Jim Cramer.
Molson Coors has a real turnaround going on, as you'll see tomorrow. I think that this is an exciting stock that can go up over time.
But what do you know? The stock was down over 10% today. Every time Cramer praises a stock, run for the hills. I would actually be nervous and buy puts if Jim Cramer praises any of my stocks. That's the kiss of death right there. Let's do some corporate news before we move on. How about CVS? The New York Attorney General, whatever her name is, well, she announced suing CVS for health and violating whatever antitrust laws and hunting, blah, 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 blah. I say to the New York AG, how about all of these criminals you're letting out? Because they're robbing CVS, and the wave of crime in America is costing retailers big time, including CVS. Who do they complain to? Next, if you thought inflation is bad, it got a lot worse. McDonald's last week announced increasing the price of cheeseburgers for the first time in 14 years. This is how you know that shit got real. And the beauty of all of that, if you're a shareholder for McDonald's, that even when the recession happens, they're not going to reduce their prices. That's going to be here to stay. So their margin's actually going to improve under a recession. And here's the bad news for the credit cards processors, Visa and MasterCard. All reported earnings last week. Things are looking okay from an earnings perspective, but we have a problem. The fees they're charging are absolutely destroying and decimating small businesses in the country. Therefore, if you're going to visit a small business, pay using cash. Because every time you swipe those credit cards, the business owner is actually cutting Visa and MasterCard in the transaction. I mean, when you really think about it, the business model of Visa and MasterCard is the same model as the mob. And then we have Ukrainian clown Zelensky, who's doing Vogue magazine covers while his people are getting slaughtered, to save democracy, the same democracy that we're sending billions of dollars to in money laundering schemes, perhaps going to the Belize accounts of Mr. Zelensky. War is good for him. He's getting richer. But maybe I'm going to support President Z in his endeavor against JP Morgan Chase. The headline reads, Ukraine will pursue war crimes charges against leaders of JP Morgan Chase, Citi, and HSBC over Russia financing. This is according to Zelensky's economic advisor. And I say be careful here. Watch out, Mr. Z, because our government, the American government, is owned and controlled by JP Morgan. You go against JP Morgan, the next package might come a little light. That $40 billion might become $4 billion. So watch out here. And better yet, maybe when our politicians have no more scores from Ukraine, they can't make more money from it, maybe they'll give your address to the Russians to take care of you. So word to the wise, watch out. Watch your back. You can fight Putin, but you can't fight JP Morgan Chase. And here's the last one for Take Two. I got some bad news for you. If you happen to be Grand Theft Auto enthusiast, well, the good days are over now. Say hello to the Grand Theft Auto Woke Edition. They're now going with the first female lead character. I don't have a problem with that, but are they going to ruin the rest of the game? My hunch says yes. Now let's move on to the heat map for the ETFs, red across the board, with few exceptions, the inverse indices, the VIX proxies, some gains in the oil and gas, the OIH, for example. Solar, the ticker TAN, on the Manchin optimism continues to ride higher. But besides that, no gains at all, with the exception of the XBI, the biotech ETF, the leader for the day. But besides that, growth down, value down, international is down, with exception of India, slightly higher. But that's about it. The question is, are we running out of gas? When you look at consumer cyclicals, for example, the XHB down over 3% for the day. This is for home builders. And home builders happen to be sensitive to interest rate hikes and how the 10-year yield moves higher. Today, we got a massive pop in the 10-year. Will that pop continue? And if it does, that light red color that you see in the map will get a lot brighter. Let's move on to charts, and we start with the 30-minute chart of the SPY, the S&P 500. What's going on here? For now, it appears that the bounce, the rally, whatever you want to call it, is stalling. That doesn't mean it's over, but it means that it's maybe running out of gas. It needs a pullback. It needs some profit taking. What I see for the chart right now is a double top formation. The chart lost 410 as support. The next support would be 405. There's a gap above that, but it is really close to 405. So we'll just say 405 is the next support. We have negative divergence on the hour side from a 30-minute perspective, so the risk versus reward says the bears have the better argument that we should see a pullback at least all the way to 405. If that is lost, then we got a problem. But so long as 405 is intact, all what could happen is a pullback, profit taking, and then we see the dip buyers showing up again. They showed up 2 days in a row, by the way. On Monday, the futures opened gapping down. We saw the dip buyers right away, buying left and right. Today, similar story. They buy in the morning. We see a gap down in the morning. The dip buyers show up right away. They buy the dip, and then they eat an ice pie in the face by midday. And that right there tells you that we have a battle. It appears that the bulls are running out of gas. It appears that the charts are looking for a pullback. But we also have the dip buyers showing up day after day. Therefore, I say watch AMD. That's the key. If AMD goes down 4 or 5% tomorrow, if they buy the dip right away, higher we go. But if AMD doesn't find dip buyers, then the SPY, the Qs will also go down. Here's the daily chart for the continuous contract, the SPY, the S&P 500. So far, so good. An impressive summer rally that got us all the way from around 3,720 all the way to 4,100. This is an impressive rally, a bear market rally for now. But we have bad signs that the rally is stalling. What do I mean by that? Number one, the volume went higher above average on a down day. Number two, the momentum indicators are getting a little overextended, at least the MACD indicator. Number three, the zone between 4,100 and let's say 4,200 offers really, really tough resistance. I don't think the chart's going to blast above that zone easily, without pullbacks, without consolidation at least. Now, the consolidation that we see right now, as it is positive. It could be a bull flag consolidation. But it starts to become troublesome if the chart moves down and loses 3,960 as support. So this is the number you want to watch for if you happen to be a bear. But for now, all of this is bullish consolidation, at least for now. But if the key support is lost, we got a problem. And here's the daily chart for the SPX, the cash index. Now I want to illustrate something for you. On this chart, the most important number, if we clean up all the previous markings, happens to be also at around 4,100. This zone acted as support and resistance over and over and over and over again. The assumption for now is it should act as resistance. That means a pullback. The question then becomes, will the dip buyers show up again and buy the dip? If that is the answer, then higher we go, above 4,100. But if the dip buyers don't show up, we start to see more bad news piling up. We see the Dixie moving higher, the 10-year yield moving higher, more hawkish talk by the Fed. Then 4,100 will be a double top, and down we go. The Qs, the NASDAQ, 30 minutes chart, what's going on here? A similar pattern. We have negative divergence on the RSI. We have what it appears to be a double top for now. The chart lost 316.5, but that remains resistance for now. The center of gravity is 313. Now, old viewers of this channel remember Mrs. 313, the notorious 313. It acts as a center of gravity for the chart, meaning the chart cannot really go above 313 in an impulsive fashion without spending a little time with Mrs. 313. That means consolidation. Consolidation at 313 is positive because it means that the next step is a pop higher. But if the triple Qs think that it can pass higher above 313 without paying the respect that 313 deserves, then guess what? The gravity of 313 will pull the chart down. The assumption now is if we get negative sentiment tomorrow, let's say a sell-off, a pullback, it doesn't matter what you call it, because bad news from China or more hawkish talk by the Fed, we have 313. That would be good support, but in all likelihood, in a sell-off scenario, it's not going to hold. We will see the next support at around 307.41. But that gravity will still be with us, pulling the chart up again. So the bears must aim for not just losing 307.41, but to get out of the sphere of gravity from 313, they need to get the chart all the way down to 297.5. Then we're talking. What about the futures? The daily chart for the NASDAQ futures. So far, so good. Consolidation within a zone. The support, 12,766. The resistance at around 13,300. The pattern remains higher lows, no problems here. But we're seeing some signs that the rally is stalling. Volume is moving higher. Momentum indicators getting overextended. The risk versus reward says a pullback is coming. If the pullback produces another higher low, so far, so good. But if it goes down, it loses, let's say, 11,689, forming a lower low, then we got a problem, and we will see a lower low in the entire chart, meaning that June bottom that we got at around 11,000, that will be violated. But for now, so far so good for the bulls. Here's the IWM 30 minutes chart. What's going on here? A decent rally that got us all the way to 188, a tough resistance line. We have negative divergence on the RSI. We also have what it appears to be a bear flag pattern at around 188. If that plays out, we have support all the way down at 182.81, and then we'll take it from there. The dollar index, the most important chart, it appears that the negative momentum in the dollar is reversing course. And if that is the case, bad news for commodities, but specifically gold, and bad news for the stock market. Look at the RSI. It is about to reverse negative divergence. Look at the MACD. Those red columns are getting shorter and shorter and shorter, indicating the weakness, at least the worst of it, is behind us now in the dollar. And it got us down from around 109 all the way to 106. Not a major pullback. The dollar is still making higher lows. Not a good sign here if the dollar pops higher again tomorrow. What about gold? It got all the way to 1,763, the resistance, but it's not keeping that for now. And if the dollar reverses course and starts to move higher again, gold is going down, and the support would be 1,685. What about Brent oil? 4 hours chart. The reverse head and shoulder pattern is now out of the window because the chart could not make it above the resistance of 105.84. It is now all the way down to the support of 99. It doesn't look good here. Why couldn't Brent make it above 105.84 last week? Do we have a catalyst that could pop this chart higher above 105.84? Because it certainly needs some fundamental help, and that could indeed happen from the upcoming OPEC meeting. Keep your eyes on that one. Here's the daily chart for the U.S. 10-year yield. We got a rebound from the support at around 2.54, and the pop got us above 2.72, another resistance, now support. The next step would be 3%. When we look at the momentum indicators, the RSI, the MACD, all firming up again, but we have yet to have a confirmation from the MACD showing us green impressions in the histogram that the weakness is behind us. But you got to put 2 and 2 together here and be fast in your thinking. 3% will be tough resistance, but if the chart gets all the way there, let's say by tomorrow, the impulsiveness is what really rattles the stock market when it comes to the bond market. It's not the number. It's not 3%. Matter of fact, when the 10-year was exactly at 3%, the stock market was moving higher. So once again, it's not the number. It is the impulsiveness of the move higher. Here's the weekly chart for the TLT. Not a good looking candle here. It is a topping candle, at least for now, but we still have 3 days left for the week. Now, if the chart closes the week with this candle looking like this, then the rebound, the short covering, the oversold rally is over, and down we go, and we have support at 109.5. What about the VIX? 4 hours chart. What's going on here? The VIX made it slightly above 24.29, the resistance, last week when the bull flag played out, but immediately melted down when the stock market rallied, and it lost 24.29 as support. Now it is giving it another shot, and you're seeing the beginning of positive momentum on the MACD indicator. This is a 4 hours chart, which in all likelihood, if this plays, this could be an ABC pattern. The chart made the A leg all the way to 24.29. That proved to be a tough resistance, at least for now. It took a leg down. It is gathering energy to pop once and for all above 24.29. And that would be bad news for the SPY. Now, when it comes to the VXN, the VIX with the NASDAQ, we don't have the same clarity with the VIX, regular VIX. For now, it's a toss-up. It doesn't say anything at all. The good news, if you happen to be NASDAQ bear, is the fact that the chart kept 27.5 as support, at least for now. The next level I'm eyeing is 32.72. If the chart makes it above that number, then we have a rally in the VXN and a pullback sell-off in the Qs. And perhaps the sell-off in the Qs will be led by this name, Apple, the big kahuna, the most important name in the stock market. An impressive rally, notorious, with very little stops from all the way at around, let's say, almost 130 to 160. And after earnings, the chart popped higher, leaving a massive gap between 157 and where it is right now at around 160. This gap will be closed. That is rational, specifically when you have overextended RSI and MACD indicators. The risk versus reward says Apple will go down to close that gap, and then we'll take it from there. If we have a rebound, so far so good. But if the chart loses 157 as support, bad news, the rebound is over. Tesla, 30 minutes chart, what's going on here? An impulsive rally led by short covering and a gamma squeeze right after earnings, but it was fueled once again by the Manchin deal, more subsidies for EV makers. Good news for the souffle, but we're seeing a negative divergence on the RSI. We're seeing a pattern of lower highs and higher lows, a triangular pattern of consolidation. It appears, at least for now, from a 30 minutes perspective, that this consolidation pattern is being broken to the downside. And if that is the case, then we have the support of 886. If that doesn't work out, we have 866. And after that, we go down all the way to 825. We'll take it one step at a time. What about Bitcoin? Tulips, an hourly chart. What's going on here? 2-hour chart. What I'm seeing for now is a pattern of a sloping line of resistance forming lower highs, and the chart could not make it above that line over and over and over again. For now, the pattern is bullish, but the chart has to break above the sloping line. If it fails again, In all likelihood, it doesn't have the energy to pass above this line, and the chart will go down to the next support at around 22,000. But if the chart breaks above this line, and we see another pop in BTC, that will mean risk on not just for cryptos, but also for the stock market. So keep your eyes on three things. Number one, AMD. Are they going to buy the dip or not? Number two, the dollar. The 10-year yield doesn't really matter that much to me, to be honest with you, at least right now. It's all about the dollar. If the dollar moves higher, bad news. Number three, Bitcoin. Is Bitcoin going to pop higher again? If it does, then even if you see the Qs, the Nasdaq moving down, pulling back, if Bitcoin rallies, that means that the dip in the Nasdaq will be bought. And lastly, moving on to the conclusion of this video, what do we have on the economic calendar tomorrow? We have the ISM Services Index. This will be important. We have manufacturing down. Will services be down again? And then we have factory orders. And this is important because you heard Janet Yellen bringing that up. The factory orders doing fine. What recession? But if factory orders come out weak tomorrow, here comes another pie in the face of Janet Yellen. And with that, folks, this is all I got for you for now. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow.
Just remember, it's not a lie if you believe it.